In today's class, we'll be discussing the various models of share valuation. See, security analysis can be carried out either as fundamental analysis or technical analysis or efficient market hypothesis. What fundamental analysts do is that they will take into consideration the economic, industry, and company factors and determine an intrinsic value for the security. And then they will compare it with the market price. So when they calculate the intrinsic value of a particular share and compare it with the market price, if the market price is less than the intrinsic value, then it is understood that the security is underpriced and therefore it is best to buy that share at that moment. Because fundamental analysts believe that the market price will eventually come up or come down to the intrinsic value. So if there is a misfit between the market price and the intrinsic value, there will be a correction and the market price will come to the same value as the intrinsic value. So it's best to make use of the opportunity when there is a change in both the values. So if the market price is less than the intrinsic value, it means the fundamental analyst is hoping that the market price will, or they're anticipating that the market price will come up to the level of the intrinsic value in the future. So at present, the share is underpriced and therefore it is best to buy that share. Now, what if the market price is greater than the intrinsic value? Then again, the fundamental analyst anticipates that the market price will slowly come down to the same price as the intrinsic value. So right now the market price is overpriced. It's more than the intrinsic value. It is overpriced. So it's best to sell the share at the moment because later on the price is going to fall. So it's best to just sell it and get the best price for the security. Now, market price is available from the quotations of the stock exchange. We could get it easily from the stock exchange. So how will we calculate the intrinsic value? Calculation of the intrinsic value of shares is known as share valuation or stock valuation. If you are calculating the intrinsic value of bonds, it is known as bond valuation. So let us get familiar with a few terms before we look into the various models of share valuation. First one is time value of money. Money has a time value. Money received today is worth more than money received after 1 year. This is because if we get some money this year, we can invest it in a bank and next year we'll get that money plus an interest for the money that we deposited. If we are waiting for 1 year to collect that fund, then we will not be able to get that interest because we are unable to deposit in a bank. We will not be able to make any extra income out of it. So it's best always to get money as fast as possible in your hands. Earlier receipts are more desirable than later receipts because earlier receipts can be reinvested to generate additional returns before the later receipts come in. That is what I already explained. There's also the problem that the value of money might go down. See, if you're going to a shop today and giving 1 rupee, you'll get 2 toffees. That means that 1 toffee is worth 50 paise. So your 1 rupee has got that much value. Maybe after 1 year, when you go to the same shop and buy the same toffee, you're giving 1 rupee to the shop owner. He will give you just 1 toffee. That is because the value of money has gone down due to inflation. And therefore, it is best always to get money at the earliest. The next term to be familiar with is future value. What is future value? Future value is the amount that you're going to get in the future if you invest your funds right now for a certain percentage of interest. So the future value can be calculated by using the compounding process. So if an amount is invested now for n number of years at a rate of interest, we can denote it as R. The future value to be received after that number of years can be calculated using the compound interest formula. The formula is F, that is the future value, is equal to P, which is the principal amount that you invested into 1 plus R the whole raised to n. So that is the formula for calculating the future value of a present sum of money. Now let's see an example. Suppose you're investing rupees 1000 in the bank and you're planning to deposit it in the bank for 3 years at 10% interest. So you're hoping to earn an interest at 10%. The amount to be received after 3 years would be calculated using the compound interest formula. That is the future, that at present you're depositing 1000 rupees. So that will be received after 3 years. Plus, for every rupee that you invested, you're going to get a 0.10% interest. So you're going to get an interest for every 1 rupee that you invested. That is why we are using the formula 1000 into 1.1. That is the actual amount plus interest for a particular year. That is 1000 into 1.1. Now you're going to get that amount for 3 years. That's why we put the raised to 3 or raised to number of years simple there. So F is equal to 1000 into 1.1 the whole raised to 3 simply means you'll get back the 1000 rupees. You'll get a 0.10% for each rupee that you invested into 3 times because you're investing it for 3 years. So that is how you calculate the future value. Now what is the present value? Suppose you decide to get a certain amount in the future from your investment and you want to calculate how much you should deposit right now to get that desired return. Then we can calculate the present value. The present value is calculated using the method known as discounting. The formula for calculating the present value is P is equal to F divided by 1 plus K the whole raised to N. That is nothing but the reframing of the formula that we saw here. Here we want to calculate P. So we are going to transfer it to the left side of the equal sign and we are going to put F on the other side and then divide by 1 plus R. R and K are both the same. K is just the, when R was considered as the rate of return in the previous case, here K denotes the discount rate, which is nothing but the required rate of return. That is the percentage of return which the investor expects to get from that investment. That is denoted as small letter k, known as the discount rate. So to calculate the present value, formula is P is equal to F. F is the future value divided by 1 plus K. K is the discount rate, the whole raised to N, where N is the number of years. For example, if rupees 500 would be received after 2 years and if the discount rate is 10%, the present value can be calculated as follows. See, a person expects to get rupees 500 in the future and he is planning to invest for 2 years and the rate of return that he expects to get for the investment is 10%. Then how much should he invest right now? That is substituted by the formula and we get rupees 413.22 as the answer. So the person or the investor should invest 413.22 to get 500 after 2 years if the discount rate is 10%. Next is to find out the intrinsic value of a share. See, intrinsic value is just the present value of all future benefits expected to be received from that share. So you're going to get benefits in the future when you make an investment in a particular share. The benefit is going to be in the form of annual dividends and the sales proceeds that you're going to get when you sell that security at the end of the holding period. So the present value of all future receipts is known as the intrinsic value. What is the amount that you have to invest right now to get all that benefits in the future? That is calculated in the as the intrinsic value. Now, once we know the receipts, that is the annual dividend, how much is the annual dividend that we expect, what's the sales proceeds that we are going to get, then we are going to calculate the rate of return required. That is known as the discount rate. When you're making an investment, the investor will take into consideration the risk involved in that particular investment, and he will also look into other alternative investment opportunities. If he had invested in some other area, then what would have been the return that he get for the same amount of money. So after taking into consideration alternative investment opportunities and the risk involved, the investor will have a certain percentage of return as his desired rate of return. That is the required rate of return that he should get in order to invest in that particular security. That is known as the discount rate, which is denoted as small letter k. Now, the valuation model used to estimate the intrinsic value of a share is the present value model. So, we're using the present value model to calculate the intrinsic value of a share. Now we are going to look into the various models of share valuation. The first one is 1 year holding period. Okay. Suppose the investor purchased some shares, he wants to hold it only for 1 year. Then at the end of the year, he is going to get the dividend for that year as well as the sales proceeds from that security. So the formula to calculate that is SO is the variable used to denote the intrinsic value. So intrinsic value is equal to D1. D1 is the dividend that he is going to receive at the end of the year, divided by 1 plus K the whole raised to 1 plus S1 by 1 plus K the whole raised to 1. S1 is the sales price that is going to get when he sells that security at the end of the 1 year. So the amount of dividend expected to be received at the end of 1 year. S1 is the selling price expected to be realized on sale of the share at the end of the year, and K is the rate of return required by the investor. It is raised to 1 because the securities are held only for 1 year. Let's look into an example. If an investor expects to get 3.50 as dividend from a share next year and hopes to sell off the share at rupees 45 after holding it for 1 year, and if his required rate of return is 25%, the present value of a share to the investor can be calculated as follows. We just need to take into consideration 3 facts from this question. What is D1? That is the dividend that you are going to receive next year or at the end of this year. That is 3.50. Now we need the value of S1. For how much is he going to sell the share at the end of the year? That is rupees 45. Now what is the K value? That is the required rate of return, which is 25%. Now we have got all the necessary data from the question. We are going to substitute in the formula. So S0 or the intrinsic value is equal to 3.50, which is D1 divided by 1.25 the whole raised to 1 plus 45 divided by 1.25 the whole raised to 1, and you get the answer as rupees 38.80. So this is the intrinsic value of the security. So he will buy that particular security only if its current market price is lower than this value. If the market price is higher than this value, he will sell the security for sure. Now let's look into one more question. A share is currently selling for rupees 65. The company is expected to pay a dividend of rupees 2.50 on the share at the end of the year. So you got your D1 as 2.50. It is reliably estimated that the share will sell for rupees 78 at the end of the year. You got your S1 as well. Now we need the K. Let's see the A part of the question. Assuming that the dividend and price forecasts are accurate, would you buy the share to hold it for 1 year if your required rate of return is 12%? So I got the K value as well. So we need to make a decision as to whether we should buy the share for rupees 65 right now or just not do anything. So to do that, we are going to calculate the intrinsic value using the D1 value, which is 2.50, using the S1 value, which is 78, and the K value, which is 12. So applying all that into the formula, we'll get 2.50 divided by 1 plus 0.12 plus 78 divided by 1 plus 0.12, which is rupees 71.87. The 71.87 is the intrinsic value. The current price is the market price of the security. So the market price is currently lower than the intrinsic value. So in future, this price is going to rise up to rupees 71. So right now it is available at a underpriced value. It is available for 65. So it's best to buy that security. Now the second part of the question, let's look into the second part of the question. Given the current price of rupees 65 and expected dividend of 2.50, there is no change in that particular part. D1 is 2.50. What would the price have to be at the end of 1 year? Okay, so we have to find the S1 value to justify purchase of the share today if your required rate of return were 15%. So your rate of return or K value is 15 or 0.15. D1 value is 2.50. The intrinsic value has already been given as 65 here. We are going to take it as 65 because the current price is 65. Then what is going to be the price that you are going to sell it for? Let's see the second part of the answer. So the current price is 65, D1 is 2.50 and K is 15%. We have to determine the sales price at the end of the year, which is the S1. So we're going to denote it with an X here. So 65 is equal to 2.50 divided by 1 plus 0.15 plus X divided by 1 plus 0.15, which will give you a value of 2.17 plus X divided by 1.15, the whole raised to 1. Now you're going to take the 2.17 to the other side of the equal symbol. So it's 65, a positive number brought to the other side will give you a negative number. So 65 minus 2.17 is equal to X divided by 1.15. Now we have to cross multiply to get the answer. So 65 minus 2.17 into 1.15 will give you the X value. So the X value is calculated as 72.25. A selling price of 72.25 at the end of the year would justify the purchase of the share at the current price of 65. If you're going to get the sales price of 72.25, then you can justify. You can say that it is good to purchase that particular security right now. Now the second model is the multiple year holding period. If you are planning to hold that security for more than 1 year, an investor may hold a share for a certain number of years and sell it off at the end of his holding period. In this case, he would receive annual dividends each year and the sales price of the share at the end of the holding period. So the calculation is as follows. Okay, so he's going to get dividends every year and at the end of the holding period, he's going to get the sales price as well. So we're going to calculate each dividend's value. So D1 by 1 plus K the whole raised to 1, D2 by 1 plus K the whole raised to 2, which is a second year's dividend, D3 by 1 plus K the whole raised to 3 and so on till the last dividend and the sales price is received. So this is the formula. Let's see an example. If an investor expects to get rupees 3.50, rupees 4 and rupees 4.50 as dividend from a share during the next 3 years and hope to sell it off at rupees 75. So you have been given your D1 value, your D2 value and your D3 value, which is 3.50, 4 and 4.50. You have also been given your S1 value, which is 75. And if his required rate of return is 25%, which is the K value. The present value of the share to the investor can be calculated using the formula explained in the previous slide. Just substitute all the values in the variables. So the answer is 46.06. That is the present value of the security. Now the next model is constant growth model. It is also known as Gordon's share valuation model. See, according to this model, the intrinsic value of a share is equal to next year's expected dividend divided by the difference between the appropriate discount rate for the stock and its expected dividend growth rate. See, in the multiple year holding period technique, when we are calculating a dividend rate, we said that it is not going to remain constant. The dividend rate will keep on fluctuating. That is, as the company grows, so will the dividend. So how are we going to calculate it? So then we came up with the answer of calculating the constant growth model. According to this model, the intrinsic value of a share is equal to next year's expected dividend divided by the difference between the appropriate discount rate for the stock and its expected dividend growth rate. So there are two values here, which is the K value, which is the discount rate or the required rate of return for the investor, and the G value, which is the dividend growth rate. How much do you expect your dividend to grow each year? So you're going to find the difference between that, and the numerator is going to be the next year's dividend value. The next year's dividend value is calculated using the formula D0 into 1 plus G. D0 is the initial year's dividend value. Now let's see an example. A company has declared a dividend of rupees 2.50 per share for the current year. The company has been following a policy of enhancing its dividends by 10% every year. So this 10% is the growth rate. This 2.50 is the initial dividend of the company, which is the D0. D0 into 1 plus G will give you the D1 value, next year's dividend. and the G value is 0.10. And it is expected to continue this policy in the future also. An investor who considering the purchase of the shares of this company has a required rate of return, which is the K value is 0.15. Calculate the intrinsic value. So D0 into 1 plus G divided by K minus G. All the values are given in the question. When we do all that, we'll get the answer as rupees 55. The investor would be advised to purchase the share if the current market price is lower than 55. The market price is lower than 55 and it is always advisable to purchase that security. Now the next one is multiple growth model. This model is also known as a two-stage growth model. This model was developed because earlier we decided that the dividend is going to grow at a constant rate, or then we are going to determine the dividend that is expected to be earned in the future, but there might be changes because for a company in the initial years the dividend might fluctuate, and in the second phase once the firm has reached a profitable situation, then it's going to show a constant growth. So they divided the entire time period of holding the security into two phases, the first phase and the second phase. The first phase is denoted by V1 and the second phase is denoted by V2, and the intrinsic value is calculated by adding both these values together, that is the V1 plus the V2. So the growth rate during the first phase is going to be extraordinary growth because maybe you are introducing a unique product into the market. At the beginning, yours is the only product there. So you're going to attract extraordinary level of profit and growth. But later on, competitors are going to enter into the field and then your profit is going to go down. At that day, and then after a certain point of time, it's going to stay constant for a certain period of time. So during the first phase, we are going to calculate each year's dividend separately. The multiple year holding period valuation model is calculated here in the first phase, the multiple year holding period technique. So the formula for calculating V1 is D1 by 1 plus K the whole raised to 1 plus D2 by 1 plus K the whole raised to 2 plus D3 by 1 plus K the whole raised to 3 and so on till the actual time period when it's time to enter the second phase. Now the second phase is denoted by V2 and will be based on the constant growth model. In the first phase, we are following the multiple year holding period technique. In the second phase, we are going to calculate the V2 using the constant growth model because after a certain point of time, the dividend growth is going to remain constant. For calculating that, the formula for V2 is Dn into 1 plus G divided by K minus G into 1 plus K the whole raised to N. The intrinsic value of the share is the sum of the two present value V1 and V2. It is SO is equal to V1 plus V2. Let's see an example. A company paid a dividend of rupees 1.75 per share during the current year. It is expected to pay a dividend of 2 per share during the next year. Investors forecast a dividend of rupees 3 and rupees 3.50 per share respectively. So from these two sentences, we got the D1 value, D2 value and the D3 value. That is D1 is 2, D2 is 3 and D3 is 3.50. After that, it is expected that annual dividends will grow at 10% per year into an indefinite future if the investors' required rate of return. So the G value is 0.10. If the investors' required rate of return is 20%, which is the K value is 0.20. The intrinsic value of the share can be calculated as follows. So here, the V1 can be calculated by taking into consideration the various dividends, which is 233.50 divided by 1. The formula to calculate the denominator is 1 plus K the whole raised to 1. 2, 3 like that. Now V2 is calculated by determining the formula as given in the previous slide. V2 is equal to Dn. Dn is the dividend that you are receiving in the previous phase, the last phase. That is, The last dividend in the first phase is the DN. In this case, you're receiving 2 in the first year, rupees 3 in the second year, and 3.50. So this is the last dividend in the first phase, which is the DN value as shown in the formula. It's 3.50 into, then the formula states that you have to add 1 plus the growth rate. The growth rate is 10%. That's why 1.10 or 1.1, both are the same, divided by the K value minus the G value. K value is 0.20, G value is 0.10 into 1 plus K, the whole raised to n. That is 1 plus 0.20, the whole raised to the total number of years, 3 years. So you're going to get 22.28. Now the total of both these will give you the intrinsic value of the security. So I hope that is clear. These are the various models of share valuation. There is also a profit earning ratio technique and a regression analysis, which we will be discussing in the next class. Thank you.